And retail sales growth slowed to 1.9% year-on-year in April from a revised 2.7% in March, sales down 0.6% month-on-month. But they increased by 2% in the 3 months to April. Joining me in Cape Town is Janine van Zyl, who's retail analyst at Omixa. Hi Janine, a couple of numbers there, depending on which period you look at. What do you make of this latest set of data?
Well, you have to say 1.9% real retail sales growth doesn't sound wonderful, but we have to consider that that was April month, and April didn't have Easter in this year. It had more holidays last year, so it's not really a very comparative month, and we always find it very difficult to extract real information from this month.
Now, looking at those days, I've always been skeptical. It's like when they say, if there's a public holiday, productivity drops, people don't work. But of course, a lot of people do work on public holidays, and a lot of people make up the work that they would have done on the public holiday at other times. There are a couple of the numbers that come out and they say this month isn't comparable to the same month last year. Surely that should be adjusted in the same way that companies adjust their earnings to reflect changes. Surely we should get that number adjusted for 1 day less and a different percentage?
Absolutely, they do adjust it. We do get the seasonally adjusted numbers, but that doesn't really work for retail, because actually on public holidays, retailers have higher sales as opposed to lower sales. When Easter is in the month, we have very high sales in Easter because all the consumers are out there shopping, they're on holiday, their school holidays fall then, and really the shops are fuller. So it almost goes contrary to the normal seasonally adjusted methodology. And that's why generally when we look at March and April over any year, we sum the two together and we try and extract that from the numbers. And in this case, if we're looking at sort of a 3-month rolling average, if I look at a nominal sales, which is the way we like to look at it, then we're looking at a 9% growth as opposed to the 6.3, which just the monthly growth gave us. So 9% is not a terrible nominal number. It's very reasonable, and most of the retailers can live off that.
Well, 9% sounds pretty good given what we've been told about the consumer being stressed, the number of people at the lower end who are borrowing just to eat and who are borrowing to pay off debt. So what is this number telling us about the consumer?
I think if we really look into the detail, that's maybe where it becomes a whole lot more interesting, and we're not just looking at the month on month. What was quite surprising in this month's number was that food was very weak, and food is a very big category. It showed, if I talk on a nominal level, because that's what's really important to retailers, they also like inflation. It was only up 2.3% for food, and that's not great. Volumes were actually down in food. I think they were down 4%. Whereas other categories like clothing was very strong. We saw 8.7% nominal increase in clothing, which is still a 5% volume growth, and that's great. Clothing retailers must be loving this. Not to say it's sustainable, but at least that's what this month's telling us. And then the other category that really actually threw this number down was general retail. And the general dealers are a little bit difficult to categorize because they sell everything. They're like the games and the hypermarkets. So you can't really put it in a particular category, but they traded very badly, and I'm not exactly sure why that would be. We're going to have to watch that next month and see if that's a trend.
What about the credit and cash retail? Sorry, carry on, Janine.
Sorry, another interesting but a very small category, which I find quite interesting to watch, is the hardware, paint and glass. Now that category is still trading very nicely, and it has been for quite a few months. We've got positive volume growth, about 4% volume growth, and nearly 10% top line growth. And if the builders, warehouses and the likes who actually enjoy this kind of sales are seeing that, then I'm sure that they're very satisfied.
I was going to ask you about, and I'm now going to ask you about credit versus cash retailers. So you look at some of those, the clothing stores which do a lot of credit, the furniture stores which do credit, and then of course there are purely cash retailers too.
Absolutely, but the Stats SA numbers don't give us a split between that. In clothing, of course, you have cash and credit retailers in there, and the message we're getting from the market is that they're all trading okay. We're not seeing a very big drop-off in anyone in either cash or credit. Some of the retailers have mentioned that their cash sales are slightly stronger than their credit sales. But if we look at the one small category which was actually disastrous in this month was the furniture category, and they are still seeing negative volumes and negative total sales. That's partly because deflation is still with them. So yeah, I don't think that at the moment we're not really talking a very strong cash credit difference in trading, but I have no doubt that is making a difference overall. The unsecured lending and the pressure on the consumer must be making a difference to how consumers spend at the moment, and maybe putting a bit of pressure on certain categories.
Just returning to that, the building division, you talked about places like Builders Warehouse and so on. If you look at the furniture sector, that's something that is pretty discretionary, so you can make do with the old lounge suite for a bit longer, or the old dining room table that you can manage to live with unless it's falling apart. And some of those big ticket items in the furniture shops, you know, they look like big items. But the same you would think would apply to the building type trade, where it's discretionary, but on the other hand, that seems to be going very strongly. What's the explanation for that?
I don't know that there's a categorical explanation, but the way we read it is very often when consumers are under pressure, and maybe when house prices aren't as strong as they would be, or possibly they can't get the credit that they would have liked, they actually renovate their own house. It's not always a big ticket item. It's maybe just painting the lounge and making them feel better about themselves. So sometimes much cheaper than actually buying a lounge suite, but just making your house look a bit better. I'm sure sometimes it is a big ticket item, but this kind of spend implies that it possibly is just lots of little ticket items.
Of course, the other aspect of that is the effect of the social grants, and I'll never forget interviewing the Cash Bill chief executive, Pat Goldrick, some years ago. At the height of that recession, and interest rates were high and cash was short, it was a bit comparable to where we are now, and he said their sales are just sailing ahead, particularly in places like the Eastern Cape, where the social grants, which have gone up tenfold in the last decade or so, those social grants in particular to children, which were moved further up the age range, people pool the money and they go out and they buy cement and they buy stuff and they build additions and so on to their homes. Now, but that must have a ceiling, if you like. Do you have a sense of where that market is?
Well, the last update we've had from Cash Build is that things are not looking quite as glorious anymore. You're quite right. They did benefit enormously from social grants. I think on the side, they also benefited a fair amount from the increase in unsecured lending. I would say that quite a lot of people might have taken those loans just to add on a room or buy some paint maybe, and that would have gone to Cash Build. But in the last result, Cash Build was showing very, very weak sales top line growth. And I think that probably is continuing, but that once again is we see getting a different message from the more higher end building retailers, and that would be because we think that the bottom end struggled with the strikes. A lot of them weren't paid. The unsecured lending has been dampened a bit. Maybe I wouldn't say stop, but it's not pushing forth as strongly as it was at the end of last year, and all those things will be putting a bit of pressure on cash.